Today, we're talking about Google's earnings for Q2 and how this company, which is my biggest investment, has done so well, but Wall Street is just still not rewarding Google investors. So we're going to go through Google's performance in this last quarter, go through some issues to do with its little side businesses, to do with AI and the self-driving business, Waymo. And I've also got to give you my update on the growth on sale portfolio to measure my success here on the channel in the long term. And I've just bought a share of Netflix. It's a company 15% off all-time highs, expected to grow 20% per year. So I think this is a good place to start an investment there. So make sure you subscribe to follow the journey, but otherwise, let's get into Google stock. All right, let's get stuck into these Google earnings. And first up, I just want to show here the response from Wall Street and investors in relation to that earnings news. So after hours, the stock was up around 1.8 to 2%, which was kind of disappointing. As soon as I saw the results, which I've got summarized in the bottom corner, you'll see here that earnings came out at $2.3 per share, or a 6% beat compared to expectations, and the revenue came out with a 2.6% beat. In other words, double beat. You would expect the name to be up around 5% at least after hours. What that's saying to me is Wall Street is still not pricing in the success of Google. So things like Waymo self-driving cars, that could be classed as AI. Even the Google AI Gemini business, the video generation, all of that stuff is still not being taken seriously by investors and pretty much by Wall Street.
Google VO3 now allows audio on image to video generation. It's not perfect, but this is the best we can get for now.
But more on those different business segments and opportunities later. Let's just go through the financial details of the latest quarter of results. So the revenue growth here, just running through the basic numbers, 14% growth and compared to 14% revenue growth last year. So that's actually a acceleration from really 2023, 2024. We were only getting around 11% revenue growth. So it seems like we're getting consistent and stronger revenue growth compared to a year ago. And the operating margin did not change from last year to this year, sitting at 32.4%. But as we dive deeper into the cost of the business, the operating expenses, this is kind of the back office expenses at Google. They had theirs jump up from 5% growth last year, which is actually very good. That growth jumped up 20% in the last 12 months, a huge jump in the administration costs, about a 65% growth rate in just a year, which is kind of mind-boggling. And that alone put pressure downward on the operating margins of the business. We should have been expecting around a 34.5% operating margin, except we were actually flat compared to last year. I was doing a bit of searching of why we would see that huge admin expense jump. That's just out of this world. And it was just a once-off legal cost. That's the only thing I could pin it on, where we have this comment from the CEO, where we have a comment directly from the CEO about a downward pressure in profit margins due to a legal expense. So hopefully that settlement, that legal expense, is a once-off, and we can get back to seeing operating margins consistently heading towards, I reckon, about a 40% clip in the long run. Moving on from the general business, we have here Google Services revenue. Think of that as pretty much advertising and subscriptions. So Google Search is still growing very healthily, 12% revenue growth as a yearly number. So it's clear to see that artificial intelligence, stuff like chatgpt, chatbots, that is not really stealing the lunch from Google Search. And just diving into that a little bit deeper, we see a Google Network, that sort of pink number there, actually dropped revenue growth -1% over a year. And I think that's where we're going to continue seeing a slow death in that business really for Google. Again, as the ChatGPTs and Google's own AI services stop people from clicking on websites. You know those annoying adverts, you click on a website and they pop up on the screen and annoy you. You don't even really look at the ads. Advertisers don't really even want to buy them. That's the Google Network business that is dying. Any video that is longer than a minute but not ultra professional like Netflix, anything below that quality, it's really got one home, and that's YouTube. They're pretty much a monopoly in this regard. There's some other players like Rumble, but really they've got no competition here. So YouTube is still growing at 13%. That's probably just going to continue on forever. for the next decade at least. And the last one is subscription platforms and devices. So anything like paying for some extra storage, a couple dollars a month, paying for YouTube Premium, anything that is at all listed as a subscription apparently goes in that bracket, and that is doing very well, growing 20% yearly growth. But I believe Google's AI revenue is included with Google Cloud. That grew 32% at a yearly clip, accelerating from last year's 29% growth. So still growing really well. And Google's actually just full on just adding huge amounts of profit to the bottom line, almost doubling their operating margin compared to last year, 11.3%, up to 20.7 this year. But finishing off the financial details, there's just one area of the business that is scaring off investors, and that's the capital expenditures. So spending on things like data centers and hardware, that's jumped up 70% compared to last year. Google's spending an extra $10 billion every single quarter. That's a huge amount of money building up these data centers, but it's, in my opinion, it's money well spent. They said last quarter that they're working at capacity for their Google Cloud. So yes, it's expensive to get it up and running, but every single dollar they spend on CapEx, that's probably $1 extra in revenue per quarter. They can actually service then customer requests. And eventually down the road, I'm guessing the future operating margin is around 40% for this area as well. So again, if you spend $1 today, that means you're earning 40 cents of operating profit every single quarter going off, for the next decade easily. So is that investment worth it? My opinion is yes, but this is scaring Wall Street a lot because it affects things like your free cash flow. For this tech company with subscription revenue, very safe business model, Google should be priced at a forward P ratio of 25. Really, there's no excuse other than Wall Street just stressing out over these random details. ChatGPT stealing business from Google, that's the only reason the company is probably about 30% undervalued right now. But I will point out a few extra details. I'm just going to put here the cash flow statement, and I just want to look at one little category, which is the repurchase of stock, in other words, share buybacks. Google's purchasing $13.6 billion in share buybacks, which is actually less than last year, which is maybe a little bit annoying, but it is what it is. So that's around 2% of all shares getting bought back every single year if you annualize that. So in other words, Google's growing revenue at 14%. Profit margins are slowly getting healthier as time goes on, mainly from Google Cloud getting more profitable over time. So 15% plus a few extra percent bonus from better profit margins, plus you get that 2% buyback. So I'm expecting profits per share to keep growing at a 20% clip at least for the next 5 years. But now I want to go through two major business segments of Google and address some concerns. Now, the first one I want to go through is the whole AI story. The CEO came out, Pichai, said, in terms of the AI business, he has more than 100 million active users across India and the US. So that's just 2 countries alone using the AI part of Google. AI Overviews has more than 2 billion monthly users across 200 countries and 40 different languages. In terms of users of the Gemini app, that's the AI business of Google, they have 450 million monthly active users. Daily requests are growing over 50% just from the last quarter. Now, we're going to support that growth in the AI business, looking at a comparison of ChatGPT growth and Gemini. Now, these two graphs are showing recurring users and new users, and it's just the nature of a mature business. ChatGPT got about a year's head start before Gemini. They just have a more mature audience. People know ChatGPT, they use it, they go back to it. Whereas Gemini, faster growth, people try it and then they give up. So roughly 2/3 of Gemini users come back and use the app, use the website. Whereas ChatGPT, around 90% of people go back and reuse it. So at the moment, ChatGPT has around 400 million active users, whereas Gemini only has around 115 million, so it's pretty far behind. But here's the real kicker. If I told you that ChatGPT is only growing users at a 10% yearly clip, I was absolutely surprised. I was thinking, what the hell? This is a load of BS. But yeah, ChatGPT is only growing at a 10% yearly rate in this calendar year if we annualize that growth. Whereas if we look at Google's Gemini growth, that's growing at 170%. That is smashing ChatGPT's growth out of the park. And it's only going to take, at this clip, about 2.5 years for Google Gemini to catch up to ChatGPT. And this is only a side project really for Google. Yes, it's going to be a huge success if it happens. Obviously, Google values the AI business highly and sees huge profits in the future. But right now, geez, this is only 1% of all the revenue of Google, and Google's already worth $2 trillion from the YouTube business, Google Search, Google Cloud. It doesn't even really need Gemini AI to work. It's just a cherry on top. And we can just play around with some of these details from Google's subscription and AI businesses. So having a look here at Google One, that's like the lowest tier subscription of Google. Most people don't even know it exists, but you can pay a few extra dollars every single month and you get extra free Google Drive storage, extra storage for your Gmail account. And I don't know about you, but I made my Gmail like 15 years ago. My storage is maxing out. I might be forced to pay a few dollars every month just to get the extra 14 gigs of storage. So there's a lot of people use their free Gmail account for a long period of time, might have to start paying. There's 100 million subscribers to that. And they've had a 50% increase just since February of 2024. But what's really interesting is Google has straight away found a way to monetize their AI. Many companies have struggled to actually get dollars from people to pay for things like video generation, their little chatbot, whereas Google's got a very well planned out business model. Yes, they got their high-end video generation that could pretty much replace animated movies right now. Yep, you got to pay whatever that is, $400 a year for that. That also includes your little AI assistant that can go through your Google Drive, go through your Google Docs, which is effectively Microsoft Word, and it can help you edit and generate text inside the Google Docs document. And Google's already prepared to earn $400 a year from people for those services. So if we play a little game and charge $400 per person for all of these premium AI accounts, I think it's fair to say you could get 10 million subscribers to that pretty quickly, maybe in just a year. So 10 million times 400 would be around $4 billion of revenue. That's already the equivalent of around 1% of the total revenue for Google. That might not sound impressive, but that AI business has just been created out of thin air in the last year. So 1% of the total business is actually pretty good. We're going to move on from the AI business, and I want to talk about Waymo because I think this is really a secret bonus to owning Google stock. You're really just paying for Google's YouTube and cloud. You're almost getting the search for free, the AI for free, and Waymo as well. So Waymo here, I've just got this article from Seeking Alpha. I've got a premium link in the description, but this article is just talking about analysis of the self-driving network. And at the moment, Waymo has around 250,000 weekly rides, where the average cost of those rides is around $20. Pretty good for Waymo. That's around $5 million every single week. So that's around $260 million in revenue already getting generated by Waymo. We're seeing about a doubling every year. So we're already hitting 260 million at a yearly clip. That means next year, maybe around 500 million. Year after, maybe we can even hit $1 billion in revenue. And hopefully, as the company scales higher and higher, there's going to be a bunch of issues with cost in the short term making these self-driving cars. But once they've been created, maybe they're on the road for a decade, 15 years, and eventually it can be a very profitable business. Again, this is a future play. Google's happy burning up a couple $1 billion every year, whatever it is. Either sell Waymo for $200 billion, $400 billion in the future, if they wait 5 or 10 years, or they just keep Waymo as a profit machine in the future. Either way, it's a win-win because Google's got the spare cash right now and they're happy to invest in the future. And there's even been some exciting partnerships between Uber and Waymo that have teamed up to do self-driving truck logistics. So maybe in a couple years, you could see trucks. A lot of that cost is the driver, whatever it is, $60,000, $80,000 a year paying for a truck driver, whereas maybe Waymo spends $200,000, $250,000 building a self-driving truck. Maybe Uber helps pay for half of that cost. And that's revenue and profit that can go on forever and ever as long as the truck is still going. But having a look at the forward PE numbers, if I put in my estimates of what the EPS is going to be end of 2025, 26, 27, you see here this year expecting about a 10.3 earnings per share. Wall Street's only expecting 9.66. They're consistently missing by about 10 to 20 cents of earnings per share every single quarter. They're just getting it wrong consistently. So we're getting closer to the end of the year. In terms of a forward 12-month P ratio, we're actually sitting at just under a 17. That's pretty ridiculous for a company that's going to grow earnings per share 20% consistently moving into the future. So if we put an expectation by the end of this year, let's just say Google has a forward P ratio of 20, Wall Street comes to their senses. So that means the share price I'm expecting by the end of the year is around 228. I think that's pretty reasonable. I'm very happy to hold my Google stock until we hit that price. So that's around a 15% return for the next 6 months. And then the year after, again, pretty much a 10% growth because of extra valuation, forward PE ratio of 22 by the end of next year, and about 10 to 15% growth in earnings. So altogether, we're looking at compounded 25% really returns this year and next year, which is happy days for pretty much all Google investors. So let me know what you think of the thesis. Tell me anything I did miss. We're all here to share together and try and profit while Wall Street tries to work out their left nut from their. Make sure you subscribe to see the progress of my growth on sale portfolio. See you guys next time. Bye.